What's up, everybody? Welcome to Heresy Financial. This is the channel where we talk about financial topics in a way that's considered heresy to the financial establishment. Today, I'm going to dive into my 3 worst financial mistakes, what I should have done instead, and hopefully you'll be further ahead by learning from my costly mistakes. Let's dive in. All right, before we get started, I do want to thank everybody who has subscribed to the channel so far over the weekend, past 100 subscribers. Really appreciate it. I'm shooting for 1,000 subscribers next because that will allow me to submit for monetization with YouTube and allow me to continue bringing videos like this. So if you're not already subscribed, would really appreciate that. It means so much to me, and send this along to somebody else that you think it might help as well. Today we're gonna dive into my 3 biggest financial mistakes in order of least to worst. So my first one was in college. Now I know a lot of people make mistakes in college, but this one was of a little bit more stupidity than normal. I got a full ride scholarship to college, and so I didn't have to pay tuition. In return for that, I did have to live on campus, and so my total yearly expenses were around $5,000 or $6,000 a year. Now, I had a job and I worked all through college, just like most people have to do. However, because I was so young and I wasn't really interested in it, I had not put any effort into learning about how money works, learning about debt, learning about investing or savings. And so while I worked and I only had to pay for my room and board for the year, I still took out student loans. Now, I told myself I was doing this to give myself a cushion so that if I didn't want to work, I didn't have to. But ultimately, I just spent all the money that I took out in the loans anyway. And so it didn't result in me actually having a buffer or a safety cushion. This resulted in me graduating with $15,000 worth of debt. Now, I know that's a lot lower than the average today, but again, this was particularly stupid on my part because I didn't need to. I made enough money every year to just pay my bills, but I took out the loans anyway so I could use that money for fun. Hand in hand with that debt is what I used that money for. See, I was raised with the mentality to never invest borrowed money. And so my thought was, because I'm in debt, I shouldn't be investing. I should get out of debt first and then invest. It's a very popular financial planning strategy out there, especially if you listen to Dave Ramsey. But if instead of borrowing those student loans and then using my paychecks to just have fun, if I would have borrowed those student loans and then used my paychecks to invest even in just the S&P 500, I would have graduated with double the amount of money that I owed and been able to sell half of my investments to completely pay off my debt, and I would have been left with my $15,000 still invested. Instead, I had to spend a year after graduating eating rice and beans, living in an area of town that I didn't necessarily want to live in, so that I could afford to pay off that debt as quickly as possible. Thankfully, though, being in that situation taught me that it actually is important to pay attention to your money and learn about how money works and achieve some sort of financial education. So that started me on the path to where I am today. Okay, so that's my first big financial mistake, was taking out loans for college when I didn't need to and just using all of my money that I made from working my job to spend on food and doodads. When instead, I could have used those loans to pay for my college expenses and then use the money that I worked for to invest. I would have been a lot better off when I graduated had I done that. My second big financial mistake came when I was working at Charles Schwab. Now, this was in the beginning of my career there, and I had just discovered options. Now, if you've heard me talk about options before, options are like a knife. They're dangerous, but when you use them in the right way, they can be very effective for what you're trying to accomplish. In general, it's better to hold the knife by the handle, though, than it is by the blade. So as long as you use options correctly, you're not going to hurt yourself. Well, when I first discovered options, I did not use them correctly. And I fell into a trap that is very easy to fall into, number one. And number two, a lot of high-profile investors fall into this trap as well. Now, I've done a video before about the gamma trap that is propping up the stock market due to pension funds selling puts. Now, this is an income strategy. And with options, if you're not familiar, basically you can bet on the movement or the lack of movement in a stock. Now, when you bet on the lack of movement in a stock, that's sometimes called shorting volatility. That means you're betting against a large movement. 99% of the time, you're not going to see the large movement. The problem is when that large movement happens, the amount you lose can be exponentially more than the amount you ever made. And so I got into this trap of shorting volatility, and I would make my bets riskier and riskier in terms of how much I could lose because the amount that I was making on each trade was so high. For example, if I make one of these trades on Amazon, I might earn $100. Now, there's a 99.9% chance that I'm going to be able to keep that $100. But in the off chance that I'm wrong, and there is a big move in Amazon, I might lose $10,000 or $20,000. So as with anything in investing, if there's a high likelihood of you being right, then the consequences of being wrong are going to be severe. On the flip side, if there is a high probability that you're wrong, the consequences of being right will be enormously beneficial. And so I got into this trap because I was playing that 99.9% game. There is virtually no chance that I'm going to lose. And so I kept on making my trades bigger and bigger and bigger. And then one day I lost about $20,000. Now this was at a time when I was making $45,000 a year. And so this was an insanely big deal to me. Which brings me to my third mistake. And even though this third mistake cost me less money, I say it's my biggest because I should have learned my lesson from the second mistake. On my third mistake, instead of trading options in a very risky way on individual stocks, I took the strategy of shorting volatility to the overall market. Now, if you're familiar with the VIX, it's an index that tracks the overall expectations of volatility in the market. And so you can find index funds that track the VIX. Now, they'll either do this in a long way or a short way, and that means they'll either go up with volatility or they'll go down with volatility. Now, the nature of volatility in and of itself is entropic. That means that volatility by nature bleeds out and volatility by nature goes away. Because if you have a stock or an index or a fund or a market that averages about 1% volatile, it might move up 1% or down 1%, and then all of a sudden it starts moving up or down 10% at a time, your volatility has increased. But if it then maintains that 10% is now the normal movement, well, the overall volatility then goes away because that 10% becomes normal. Even if the actual volatility of the stock or the index or the market stays the same, the expectations of how volatile that feels goes down. And so there are funds that will track this in a positive or a negative way. Now, as you might imagine, since volatility is entropic in nature, and that means that volatility naturally bleeds out, the funds that are long volatility go down. And long term, that's all they do. And you can find these ETFs. One of them is UVXY. That's the ticker symbol. If you look at a 5-10 year chart of this, the only thing it does is go down. And so they're constantly doing reverse stock splits in order to keep their shares at a regular price. But on days when volatility spikes in the market and there's a huge downturn and a huge sell-off in the stock market, this thing could pop 10, 20, 30, 50, 100, 200% in one day. Now, they have funds that are the opposite of this as well. They are short volatility, meaning that because volatility is naturally bleeding out, these funds long-term go up. But on days when volatility really spikes, these funds will drop severely. Again, this is a sucker's bet, because the market can remain irrational longer than you can remain solvent. And that's exactly what happened to me. I was going short volatility on the market. And again, just like in the last trade, 99% of the time, that volatility will bleed out and you'll become profitable again. But in this one specific case, the market dropped so severely on that one day that I had to close out my trade at an enormous loss because I couldn't cover the amount that volatility was increasing by. And so on that trade, I lost about $14,000. So again, even though that was less than my second big financial mistake, I name it as my worst because I should have learned my lesson that shorting volatility is a sucker's game. It's like picking up pennies in front of a steamroller. It's just not worth it. 99.9% of the time, you'll pick up your money and walk away. But on the one-off chance that something crazy happens that people will later call a black swan event, you'll lose more than you ever made on those trades to begin with. A far better strategy is to be on the other side of that trade, where normally your trades are losing very small amounts of money, but on the off chance that you win very big. You see, in investing, you're going to have small gains and you're going to have small losses. Those will naturally cancel each other out. You might also have large gains and large losses. With the four potential outcomes in investing of small gains, small losses, large gains, large losses, if the only thing you do is take away the possibility for large losses, Your small gains and your small losses will cancel each other out, and the only thing driving your portfolio will be the large gains. So that's why it's extremely important to implement strategies in investing that protect you against losses. Because just like with anything, whether it's CDs or bonds or mutual funds or stocks, the higher the likelihood that you're successful with that investment or that trade, the larger the consequence will be if you're wrong. Now, I know I would have been a lot better off and potentially avoided these mistakes if I would have known some of these valuable investing principles before I had gotten started. And so I have 2 kids now, and I'm trying to teach them some of these investing and basic money management habits from a very young age. Shameless plug here, I've written 2 kids books because I can't stand some of the kids books out there right now. A lot of them are super boring and don't teach any valuable life lessons. So I've written 2 books so far, and I've got another one coming out soon here, and they rhyme, they have rhythm, and they're written with information and lessons, timeless lessons about how money works. And so if you have a kid in your life, whether it's upcoming for a Christmas gift or your own kids, those are a fantastic way to teach your kids some of the timeless principles of how money works. I'll link those in the description below. Hope you enjoy the content, hope you learned something, and hope you don't repeat some of the mistakes that I have made along the way, because they're costly, and if you can avoid them, you'll be that much further ahead. Thank you for watching. If you liked it, please hit that like button and the subscribe button and share with somebody that you think will like it as well. Have a great day.